Well, who's going to take care of you when you get older? Should you get long-term care insurance? That's one of the options that are out there. Is it the only option? Well, we're going to explore a question that came in with John Stillman. Let's go. Welcome in. I am Ben George with John Stillman at Rosewood Wealth Management. Today, our topic all about long-term care insurance. John, so here's the question I want to throw your way today, and let's work through it. Do you recommend long-term care insurance for your clients? I'm 58. They've been told that now is the time to buy if I'm going to get it because it will be a lot more expensive if I wait. But it still seems awfully expensive to me right now.
Yeah. So what's being referred to here is the fact that once you turn 60, yes, if you're just getting long-term care insurance after the age of 60, it is a lot more expensive than if you'd gotten it at a younger age. It gets a little bit more expensive every year when you first sign up for it. But yeah, you kind of go over the cliff once you get into your early 60s, and then it jumps a lot in that year if you're just getting it when you're 61 or 62. Depends on the company, but that's usually the case. So a lot of people assume, well, if I'm going to have a plan for long-term care coverage, the only way to do that is long-term care insurance. And so they'll just accept whatever expensive premium they have to deal with. They'll just accept it when the company 10 years into the policy sends them a letter and says, hey, your premiums are going up or we're going to cancel it. Or you have the choice. You can reduce your amount of coverage and keep your premium the same. People just assume that's their only choice because they think, well, I have to have a plan for long-term care, so I have to have long-term care insurance. And sure, long-term care insurance is a great solution for some people. You might even say for a lot of people. But it's not a perfect solution because those premiums can go up. They can eventually price you out of the policy. I know people who have gotten long-term care policies in their 50s, and then by the time they're in their 70s, the premiums have gone up so much that they can't afford it anymore. So they got priced out of the policy right before the stage of life where they would actually need it. So it did them absolutely no good. They just paid premiums for 10, 15, 20 years in some cases, and then they get priced out of the policy. So that's one of the major downsides of a long-term care insurance policy. Again, it's a great solution for some people. For others, it's not a great solution. The good news is, yes, that is a way to address long-term care expenses, but it's not the only way.
Yeah, and that's the beauty of planning, right? Is that there are multiple ways to get to the same end goal. And I know I've seen and heard people talk about, well, they're just going to self-insure. Is that a realistic option as well?
Well, I think people, when they hear I'm going to self-insure, they envision I have to have this big pile of cash, hundreds of thousands of dollars earmarked for long-term care to be able to say that I'm self-insured. But the reality is, it's not as unrealistic for a lot of people as they might think. Let's suppose you're single and you have retirement income. Let's say you're a state employee, you're single, you're living in a paid-for home. Well, that state employee is going to have a pension from the state of North Carolina. They're going to have their Social Security benefit. So they have at least two income streams in retirement, plus what other investments they have, whatever other investments they have, plus their paid-for home. Well, if they need to go into the nursing home, they already have a head start on paying for it because now their Social Security and their pension, all of that can go right toward their long-term care bill. Maybe they need to supplement it with investment income. There's nobody living in their home now, so their home can be sold to help pay for the care. So I could consider that single individual self-insured just by virtue of the fact that their home is paid for and they don't have to keep it if they need care. Of course, it gets more challenging if we're talking about a couple. If the first spouse needs care, well, now we can't sell the home out from under the other one. So we have to have a different plan there. But my point is, for some people, the idea of being self-insured is not as impossible as it might sound. And it could be that the day that you're retiring, like let's say you have $900,000 in your retirement accounts. And we determine that you need $700,000 of that $900,000 to generate the income that you need over time, give you raises for inflation. Let's suppose we can do all of that with $700,000 of your $900,000. Okay. Well, we have a couple $100,000 here now that's not earmarked for your income. So some of it, maybe we take 100,000 of that and we put it in a different account that we're mentally earmarking as your long-term care money. Now you say, well, $100,000, with what I've heard nursing homes cost, how far is $100,000 going to go?
Yeah.
Well, keep in mind, this is $100,000 at the time you're retiring. You're not going to need long-term care, except in some very unfortunate, rare situations. You're not going to need long-term care within your first few years of retirement. We're talking about something that you're going to need way down the road. For most people, more than a decade in the future after retiring, might they need long-term care. So if it's $100,000 on the day that you retire and we can leave it alone and let it cook for more than a decade, well, now we have a whole lot more than $100,000 that could be on the table for your long-term care. So again, self-insuring, not the answer for everybody, but also not as impossible as some people might think.
Yeah, it almost sounds like for a lot of people that self-insure, they almost overestimate what they're going to need.
Yeah, well, here again, you're not starting from ground zero, right? Because you have income. You're going to have at least your Social Security. You probably have some other income too. So some of that income can go toward paying for your care. You're not starting at $0 and we have to get to $9,000 a month from that point, or however much it costs for your care. So yeah, a lot of people are more within striking distance of self-insuring than they might think.
So that's a couple different options. Another one that I've heard is life insurance, right? There is a way to utilize life insurance to help pay for long-term care. How exactly does that work?
Yeah, so you have to have a special type of long-term care policy that has what's called an accelerated death benefit. Sounds a little ominous. We don't want to accelerate your death, but we're not accelerating your death. We're accelerating the death benefit. Another maybe more palatable way to phrase it is a living benefit. So the way that works is, let's say you have a life insurance policy with a $300,000 death benefit. It's going to work like any other life insurance policy. When you die, your beneficiary, whether it's your spouse or your kids or whoever, gets $300,000. However, if you have that accelerated death benefit and you need that long-term care help, basically what the life insurance company says is, well, if he or she needs long-term care, they're probably not going to live much longer anyway. So we're probably going to need to pay this death benefit out before too long. So we might as well let them use that death benefit while they're still alive to pay for their care. So you see, we're accelerating the death benefit. You're taking advantage of the death benefit while you're still alive. So now that $300,000 is on the table to help pay for your care. So maybe you take $50,000 out of that 300 every year for 4 years to help pay for your care. Well, if you did that, you took $200,000. Now there's $100,000 left in death benefit. If you died after 4 years, that remaining $100,000 would still pass on to your beneficiaries, just like any other life insurance would. And so what that does is it takes away the use it or lose it component that we have with long-term care insurance. Long-term care insurance, you pay the premiums. If you never go in the nursing home, you never realize that benefit of paying the premiums all those years. With the life insurance, with the living benefit or the accelerated death benefit, it's not use it or lose it. You're going to get the money one way or the other. You're either going to get it as the death benefit when you die, it's going to go to your beneficiaries, or you're going to use some or all of it while you're alive to pay for your care. So some people like that option. It is still life insurance. So if your health is bad, you're not going to be able to qualify for that route, or it might cost you so much that you wouldn't want to go that route. But if you have old life insurance policies that have a cash value built up in them, first thing we want to check is, does your existing policy have that accelerated death benefit already on it? You might have that benefit and you don't even realize it. I've seen people have that. Their policy is already set up for this and they didn't even know. Maybe they knew when they first got it and they've forgotten, or maybe they didn't know in the first place. So that's the first thing to check. If it doesn't, then the question is, can we take that cash value, roll it to a new policy where now you have the accelerated death benefit? Maybe you get even more death benefit than you had in the old policy, or maybe we stop paying premiums from this point forward one way or the other, you end up in a better situation with a better policy that has that long-term care component added to it. So again, several ways that we can address the problem. We don't have to use any one particular way. We just have to make sure that you have a plan one way or another to have the problem addressed.
So wrapping back around to that question, do you recommend long-term care insurance for your clients? Maybe, maybe not, right? It's kind of one of those things you work through when you have that initial meeting with someone, see what their needs are, see their full financial picture, and then come up with a plan.
Yeah, there are times where somebody has no long-term care insurance and I will recommend to them, yeah, you probably should get it. There are other times where people have a policy already that they've been paying into, and it's not that if they didn't have it, I would have recommended that they go get it at that point, but because they've already had it and been paying into it and it's a decent policy, I might advise them to keep it. And then some people I say, no, let's not go that route at all. So really could work out a number of different ways depending on your situation.
All right, good question, John. Good explanation as well. All the information to get in touch with John is down in the description. Meetwithjohn.com, though, is that link to get on John's calendar right now. Again, he is a chartered retirement planning counselor at Rosewood Wealth Management. And we appreciate you watching this video. Please subscribe to the channel if you haven't already. We'll have another video coming soon. John, talk to you then.
Carolina Wealth Stewards, doing business as Rosewood Wealth Management, is a registered investment advisor in the state of North Carolina. The material presented is intended to be general information and should not be construed by any consumer as the rendering of personalized investment advice.